CME Group halted all metals and natural gas futures trading on Wednesday afternoon, with the official explanation citing technical issues. Silver was trading at $91.30 at the time the halt began at 12:15 Central Time. Natural gas futures were permitted to resume trading at 12:50, while metals markets remained frozen until 1:45 in the afternoon, a total halt duration of approximately 1 hour and 30 minutes. During that window, no buying, no selling, and no price discovery was possible, with silver locked at $91 while broader markets continued operating. When metals trading resumed, silver dropped immediately to $88, a decline of $3, with no bounce and no pause between the reopening and the selling pressure. Gold declined $70 to $5,164 upon resumption. Silver has since recovered to $89.20, holding what had previously been identified as a resistance zone in prior market analysis. That zone is now acting as support. This halt represents the second major CME disruption within the same month. During the first week of February, settlement prices were delayed. The current event marks a full trading halt. The source material notes that prior to these two incidents, the exchange had gone approximately half a decade without major outages, making two disruptions within 3 weeks a notable departure from recent operational history. On both occasions, silver had been building momentum toward key resistance levels immediately prior to the disruption occurring. Also notable is the behavior of CME's order management system during the halt. All-day orders and good-till-date orders were canceled by the exchange. Only good-till, canceled orders that had already been acknowledged, remained active in the system. The source material identifies this order book reset as having favored institutional participants capable of reacting immediately upon resumption over retail traders who were still processing what had occurred. Silver had been approaching $92 before the halt occurred, a level identified in prior sessions as the next key target. Price had broken through $89, held it as support, and was building momentum toward that $92 level when the halt took place. The halt occurred 48 hours before March 1st notice day. Upon resumption, the $3 decline to $88 was described as immediate and coordinated, rather than gradual, with selling pressure appearing the moment the gates reopened. On the physical inventory side, COMEX registered silver declined by 2.2 million ounces on Tuesday alone, bringing total registered silver to 86.3 million ounces. The individual vault movements contributing to that decline included 155,000 ounces withdrawn from Asahi, 167,000 ounces adjusted out of Brink's registered, 647,000 ounces withdrawn from HSBC, 374,000 ounces withdrawn from JP Morgan, and 80,000 ounces withdrawn from StoneX. Some metal moved into Loomis registered, but the net result was 890,000 ounces leaving registered inventory within a single trading day. The source material notes that while the 71 million ounce March roll completed the prior session, was the largest observed and relieved immediate March delivery pressure, no new metal is reported as flowing into COMEX vaults to replenish what is leaving. Eligible inventory is present in the vaults but has not been designated for delivery, a distinction the source material identifies as significant because the structural deficit continues beyond the March contract period. The February gold contract anomaly is also noted. 4,000 contracts remain open on the February gold contract, representing 12 tons of gold valued at $2 billion at current prices. Contracts opened at the start of February would normally have been delivered or rolled prior to this point in the month. One party is still required to deliver 12 tons against those February contracts at this late stage, which the source material characterizes as outside normal settlement behavior. In Eastern markets, Shanghai spot silver is trading at $101, with Shanghai Futures Exchange futures at $106, against Western spot silver at $89. That represents a $12 premium on spot and a $17 premium when comparing Shanghai futures to Western spot. That premium has persisted through the halt and the post-resumption price decline rather than compressing. The Shanghai Futures Exchange also suspended 25 trading groups in February for violating position limits, which the source material identifies as abnormal enforcement frequency, consistent with concentrated positioning, creating systemic risk concerns. COMEX open interest is declining while SLV is recording new inflows on a daily basis. The source material identifies this divergence as reflecting a shift from futures exposure toward physically backed ETF exposure, characterizing it as consistent with delivery risk concerns rather than standard directional trading behavior. The source material states that participants do not move from futures to ETF exposure at a premium unless counterparty performance at settlement is a concern. On the supply side, Mexico remains the largest silver producer globally. Security disruptions tied to cartel-related violence are reported as continuing to escalate, making it harder to attract workers to mining operations and driving transport costs higher. The source material notes that while coordination between the Trump administration and the Mexican government may eventually stabilize the situation, current supply risk from the world's largest silver producer is described as rising rather than falling. The source material presents two scenarios for consideration regarding Wednesday's halt. The first is genuine technical failure, noting that exchanges do experience outages, that the longer reopening time for metals versus natural gas may have reflected additional required system checks, and that the post-resumption price decline could be explained by stop-loss cascades and leveraged liquidation clearing the market. The second scenario presented is strategic intervention, citing the timing of the halt 48 hours before March 1st notice day, with silver approaching a breakout level. The pattern of 2 disruptions in 3 weeks following half a decade without major outages. The immediate and coordinated nature of the selling pressure upon resumption that drove price down $3 within minutes, and the order book reset, resulting from the cancellation of day orders and good-till-date orders that the source material identifies as structurally advantaging institutional participants over retail. The historical precedent cited in the source material is the November 28th CME halt, in which trading was suspended for 10 hours on first notice day for December silver, with the official explanation citing cooling issues. Silver was trading at $53.26 when that halt began. Reports emerged at that time that a Chinese industrialist had notified COMEX of intent to take physical delivery of 30 million ounces. When trading resumed, silver spiked to $56.78 before proceeding to more than double to $121 over the following 60 days. The source material draws a direct parallel between the conditions surrounding that November halt. First, notice day timing, delivery pressure, elevated open interest, and declining available inventory, and the conditions present on Wednesday. Bringing together the full scope of developments covered in this report, silver was trading at $91.30 when CME Group halted all metals and natural gas futures trading on Wednesday afternoon at 12:15 Central Time. The official explanation cited technical issues. Natural gas resumed trading at 12:50 while metals remained halted until 1:45, representing a total freeze of approximately 1 hour and 30 minutes, during which no price discovery was possible. Upon resumption, silver dropped immediately $3 to $88 with no bounce or hesitation before recovering to $89.20, where the former resistance zone is now holding as support. Gold declined $70 to $5,164 upon resumption. This halt represents the second major CME disruption within 3 weeks, following a settlement price delay during the first week of February, after approximately half a decade without major outages. Both disruptions occurred while silver was building momentum toward key resistance levels. Wednesday's halt occurred 48 hours before March 1st notice day, with silver approaching $92. COMEX registered silver fell 2.2 million ounces on Tuesday to 86.3 million ounces total, with withdrawals recorded from Asahi, Brinks, HSBC, JP Morgan, and StoneX. The 71 million ounce March roll relieved immediate delivery pressure, but no new metal is flowing into vaults to replenish departing inventory. The February gold contract anomaly shows 4,000 contracts still open, representing 12 tons valued at $2 billion that remain unsettled past normal settlement timing. Shanghai spot silver trades at $101 with a $12 premium over Western spot, and Shanghai futures at $106, representing a $17 premium over Western spot. The Shanghai Futures Exchange suspended 25 trading groups in February for position limit violations. COMEX open interest is declining, while SLV records daily inflows. Mexico's silver supply situation faces ongoing escalating security disruptions. The source material presents the factors that could delay or contain the current setup as the completed March roll. The possibility of continued rolling into May and July, potential Shanghai premium narrowing, and potential Mexico stabilization. Against those factors, the source material presents registered silver continuing to decline despite the completed roll, physical metal continuing to leave the system, the Shanghai premium not compressing despite Western paper price declines, and the underlying structural conditions of delivery pressure approaching settlement with elevated open interest and declining available inventory remaining unresolved. All vault inventory figures, order book data, Eastern premium levels, open interest readings, contract settlement anomalies, and historical precedent data referenced throughout this report are drawn directly from the source material and are recommended for independent verification through primary sources including CME Vault reports, Shanghai exchange data, and February gold contract settlement records. That concludes this broadcast report on the Wednesday CME metals trading halt and the associated developments across silver and gold markets.